How can you invest in other people's projects and make some good returns out of it? So every now and then you probably have seen that somebody brings up an interesting offer for you. Maybe it's a real estate project, maybe it's a hotel project, motel project, or maybe land project. But how do you figure out what should you do with it? What are some of the red flags? What things you should watch out for? What you can do and you cannot do? What are your rights and responsibilities? So I'm going to talk about that because I think we need to explore different kind of opportunities because, if we are kind of always stuck with one kind of asset, then we're not taking advantage of some of the other possibilities out there. But that also brings on some risk because the data is not always transparent. Information is not always available. So how do you make decisions? And how can you kind of spot if something is going wrong? So we are going to address all those kind of things. So let's get started. Number one is if somebody comes to you and they market some sort of opportunity to you. So one of the four things are probably happening. Number one, it could be just a small business owner trying to sell their business. Then it's just a transaction between two people. Maybe you like the business, you can work with the owner directly and buy it. So that's one. Another kind of transaction you might see is somebody wants to raise funds and they want to give you some guaranteed return on that. So they might say, hey, I'll give you 10% a year or 12% a year or 20% a year, whatever that might be. That is like, they want to borrow the funds and you're lending money to them. That's just like lending anything else. So as long as you have a good note that makes sure that your interest is protected, you are good to go. These two are pretty straightforward processes. Although, if you are planning to buy or sell a property, I still recommend that you set up a consultation appointment and we dig a little bit deeper into it as to what are some of the red flags. But that's a topic for another day. So I'll skip that for a second. If you are lending money to someone, then it'd probably be a good idea to have an attorney draft a note for you. And if you don't want to spend money on a note, then at the bare minimum, maybe you can use some sort of AI or some of the templates out there and at least, generate a note for yourself. So before giving on the money, have a written note. So that would be the second one. In addition to that, what you will probably see is some people will approach you because they have created a fund, some sort of investor fund. That means they pool the money, you put the money in it, and then fund goes out there and do things with that fund. So that's one. Second one you might see is they might say, hey, we have created a syndication. And third one you might see is that somebody is looking for a partner. So there are typically these five different options out there. Number one, somebody just buying, selling a property or business. Number two, somebody wants to raise funds by charging you, by willing to pay you some sort of interest on it. Number three, somebody has created a fund. Number four, somebody has created a syndication. And number five, somebody have created some sort of partnership. Each one of them are quite different than the other one. So it's important that we understand the difference between all of those. Because if somebody creates a partnership, then the way you will participate in that partnership is quite different than if you participate in a fund. So today, um, let's start with fund and then we'll move on to the other one. So, what is a fund? If we can describe that, then I think we will understand quite a bit. A fund pools capital from multiple investors to invest in a diversified portfolio of assets. So, meaning the fund manager who makes investment decisions on behalf of all investors gets to choose what he or she might wants to do with it. So it's very important that if somebody approaches you and asks you to invest in a fund, you actually understand it very, very well. And I'll dig deep a little bit more into it just in a second. But first, I want to make sure you understand what the fund is and how they works. Investors commit capital to the fund. So you might say 100,000, 200,000, whatever, or fund might set up a requirement. They might say, hey, we're going to take somebody who invests minimum $50,000 into it. However, as an investor, you might not necessarily know how that money will be invested. Sometimes funds will disclose it, sometimes they might not disclose it. Funds will have some sort of predefined life cycle, maybe 3 years, 5 years, 7 years, 10 years, whatever. For example, maybe there's a fund to buy a particular real estate project, and the idea is to hold it for 3 years, 5 years, and then either refinance it and return the money back to all the investors, or perhaps sell it. Funds can invest in multiple assets. So they can invest in stocks, they can invest in real estate, they might do some construction. It's really up to the fund manager. For example, a real estate fund might invest in residential, commercial, and industrial properties, and they can do it in different locations. So they're not restricted to do it in a particular place. The returns are generated from the overall performance of the portfolio. Investors will typically receive distribution based on their share of the funds. The problem here is that investors have limited control over individual investments or decisions. Most of it is a discretion of the fund manager. So that's where the problem comes. Second part is funds typically charge some sort of management fees. It could be whatever they can even do and kind of pay structure as well, right? So they might say we're going to charge you 2% of total assets, and we will take performance fees. You typically see these with like mutual funds or venture capital funds. For example, a venture capital fund might raise 100 million, $200 million from investors and then invest in 20 different tech startups. Investors receive returns based on the collective performance of all the startups. So we see that in all kind of IT games. Now, before I proceed to some of the other types of investments you can possibly make, I want to go over what are some of the questions you might want to ask to better protect yourself. So, for example, let's say if somebody approaches you with a real estate fund, because I'm seeing more and more of those, people want to do um, apartment buildings, people want to do single family homes, people want to do hotels, motels, all kind of projects. So I see those clients on a regular basis. So I'm going to empower you today with some basic information. If you're about to do such a decision and you want to know what are the kind of questions you should ask, then you can always set up an appointment with me and tell me a little bit about what you're trying to do, and I can help you figure out what should you ask. So once again, I'm not an investment advisor, so I can't tell you whether a particular investment is good or bad. I think that should be your decision. However, I can coach you, guide you in asking the right questions. And you'll be quite surprised how things will change, because when you ask the right question, you will have so much better information for making a decision. So, because I had to pick an example, so I'm going to pick an example that somebody approach you, they have a real estate fund that is, maybe doing some sort of development. So, what are the kind of questions you want to ask? I would probably start out with, what is your investment strategy? What type of real estate projects the fund will invest? Is it going to be residential, commercial, mixed use, hotel, motel, restaurant? More information you have, the better it is. Understand whether the focus is on ground up developments, redevelopments, or value add opportunities, because each one is different. For example, if somebody is doing ground up developments, are they going to buy the land? They're going to get all the permits. They're going to get the land ready for construction. You need to understand all the stages of construction before you go invest in that particular project. If they're doing redevelopment, then you need to understand the demographics and what kind of opportunity that might create. If they're doing some sort of value add, maybe they just say, look, we bought this particular property, we're going to remodel the interior and rent it for more, then you need to understand that. Ask them, what is the fund's target market or geographic focus? Remember, like I said, everything is under the fund manager control, but at the same time, they can't lie to you. So if you ask them a question and they don't want to answer, then you don't have to invest. So feel free to ask them as many questions and try to get those answers in writing. Determine the specific region or cities where the fund plans to develop the real estate, and ask why those markets are chosen. What's so special about them? Or what kind of demand drivers are there? Where do you see things will be in next 5 years, 10 years? And that brings up to another important point. What is the fund life cycle and timeline for investment? Understand the fund's duration and when you can expect returns. Ask about the expected timeline for each project and what would be exit strategy. Sometimes it might be one exit strategy, sometimes it might be more than one. What are the expected returns and how are they calculated? Remember, nobody can really tell you what will happen, but there is some estimate these people might have come up with. So if you can understand how they came up with that estimate, for example, when I buy stocks, I look at a company, I look at some fundamentals, but at the end of the day, I still do some sort of financial analysis on that company to ensure that the project is not overpriced. Whatever am I buying, it's not, I'm not paying premium dollars for it. So that's why it's important that you agree with whatever valuation they have come up with. Maybe they made a mistake, maybe it's a bad valuation. So you need to do your own valuation. Inquire about the IRR, the internal rate of return, cash on cash return, and equity multiples. So if you don't know these terms, I'm not going to go over them in today's video, but we can talk about that in our discussion call later on, or perhaps I can make another video and talk about these. But these are the three different metrics I will probably ask them to provide me. Ask them how these projections are determined and what assumptions they're based on, and then reverse it. What if their projections are wrong? What if those assumptions are wrong? You got to also understand the fund's fees. Get clarity on all fees: management fees, acquisition fees, performance fees, any fees that you didn't ask them about, right? Get it in writing. What's the maximum amount of fees you will have to pay? And ask them how these fees will impact your overall return. What is the minimum investment requirements? Because maybe there are multiple options and maybe you choose one option or the other. Figure out how the distributions will be made. Ask about timing and method of distribution. Would that be once a year, once every 2 years, quarterly, whatever it is? Figure that out. Understand if distributions are paid out of operating income, capital gains, or refinancing. So those are, there are different ways. And although they might not answer that for you, but I would probably also look into the tax consequences of all this as well. Don't forget about the risk management as when you're talking to these kind of people. Ask about market risk, construction risk, financing risk, and any other potential challenges. They might have some of it in their brochures or some literature they might provide, but if you're not satisfied with it, ask them those questions. Inquire about how the fund manager plans to mitigate these risks, and also figure out who determines who will be the fund manager in the future. Maybe you like Mr. X or Mrs. X, and after you invest, maybe the fund manager changes. And what happens if that fund manager is no longer there? Does that fund manager have insurance that compensates the investors? Because that's a risk as well, because you're depending on that person to run the entire show. What is fund's leverage strategy? Ask about the amount of debt the fund plans to use for its project. Are they allowed to raise funds from this project and then finance another project? Understand the loan to value ratios and how debt will impact your overall returns. What happens if project runs over budget or behind schedule? Who is responsible? Who's going to pay for that? What are the contingency plans? What are their approach to managing cost overruns and delays? How are they going to run that? And keep an eye out on it. What is the track record of that fund manager and the development team? They have any previous projects? Request information on their past returns, timelines, and any challenges faced. If they had prior LLCs, you can always ask them for tax return. More than likely, they will probably say no, but it doesn't hurt to ask. And then you can always get your tax professional to review that for you. You can always ask for financial statements of that fund as well as the fund manager if you want to. I mean, again, they don't have to. They can say no to certain things, but you can always ask. Understand who will make the investment and development decisions. Ask about their experiences, whatever they are doing. So if somebody's doing, for example, um, uh, apartment building, so do they have experience in building apartment buildings? Ask for references, ask for case studies. Governance structure of a fund is also important. Ask them to provide documents, how decisions are made, what kind of oversights are there, what if somebody does a fraud, is there an advisory board, is there an investor committee, how can you get on an advisory board, how can you be part of investor committee, what are the terms of the investment, are there lock-in period, redemption policies, penalties for early withdrawal? What about your legal rights as an investor? Any clause that can affect your investment? In my opinion, if you were my client, you come to me, I'll tell you whatever I think of the particular fund is, like based on my personal knowledge, but I'm not a lawyer, I'm not an attorney, and I'm definitely not an investor advisor. So what I like to do is whenever you put enough money, if you're spending small amount of money and you're willing to take a risk, then that's fine. But otherwise, I like to get a good attorney involved, have them review it and explain to me. Although these days you have AI technology that can kind of make things simple, I still believe having a good team on your back, especially if you're making a significant investment. That's my strategy basically. Make sure you're very clear on exit strategy. Many times when people come complaining about funds, oftentimes the investor themselves was not very clear on exit strategy. They thought fund will exit this way, but the fund manager says, no, we did not promise you that. So figure that out. If you have it in writing, I think that'd be very, very helpful. Understand how and when the fund plans to exit from those investments, and like I said earlier, figure out how would those exit take place. Is that the sale of the project, refinancing, or something else? Make sure you understand how the profit will be distributed. If there are different class of profits, why that is, got to understand that. Before we move on to another topic, I want to point out two other important things from my experience. Number one is market is changing all the time. So market conditions are never the same. You might get into a project right now thinking it will be a great project because you believe in the market, you believe in the fund manager, you believe that that project going to be successful, but economic conditions changes. So ask the fund manager, how is this fund positioned to handle economic downturns, interest rate changes, market fluctuations? I mean, you're not, remember, when you invest in a fund, you're taking a risk. You can lose your entire capital. So I'm spending good amount of time to educate you on this because you need to do your due diligence before you give money to them. Unfortunately, most people come to me after they have spent the money with somebody else, and they don't quite understand these things, and then I go through them and they go like, but it's too late, right? What are you going to do at this point? You already gave them the money, you already agreed to their terms and conditions. So please, if you're planning on doing this, then watch it. Inquire about the fund's outlook on the real estate market in their target area, because that can have a big impact as well. If the project is in a particular area, do your own research. Figure out what's going on with the rental market, what's going on with the job growth, what's going on with population growth. Basic stuff, like kind of like if you're buying a house. Most importantly, figure out if this fund manager, is this fund going to be transparent with you, and they are going to provide you proper reporting. If you don't know the answer to that question, then get it in writing. How are they going to provide you transparency? And how are they going to provide you ongoing reports? Figure out the frequency. Is it going to be weekly, bi weekly, monthly, quarterly? Would there be meetings? Would you get to ask a question? Would you be an isolated investor? Would they bring all the investors in a in a group meeting so that way investors can interact with each other? Because I might, for example, if I'm investing a fund and you are the fund manager, maybe I don't know what to ask. Maybe somebody else get to ask. So that's why we run our discussion group. So when we take a look at the business or a company or a particular project, everybody can ask the question. That way we have more information. That's the idea behind the discussion calls we do, and that's the idea behind meetups I do. So that way we can become more clarity. I don't know all the answers. I don't claim to be an expert in any field at all. In matter of fact, everything that I have learned in my life, I learned it from this world, from people like you. And so going forward, that strategy still works. So if I can work in a group format and I can get information from everybody else, I will make a better decision. So ensure that there's a clear process for addressing the investor inquiries. So that's how I would probably prepare myself if I was investing in a particular fund. Now, let's move on to a couple other categories. Like I said, I talked about partnerships and I talk about syndication. So let's more talk a little bit about syndications and partnerships as well. So syndication is kind of a partnership at the end of the day, right? So syndication is a partnership between investors to pool resources for a single investment. Typically used for a large investment that would be difficult for individual investors to fund on their own. So, for example, if two or three of you guys got together and you built up a partnership, that usually be a smaller project. But if the project is bigger, then chances are there are larger number of investors, and that will be syndication. Versus if it's a smaller project, small number of investors, most likely it will be a partnership. When you create a fund, there are lots of legal requirements. You have to go through a proper structure. It takes time, it costs money. Syndication is a little bit less complicated, but it still have a lot of requirements. However, the partnerships is the easiest to create. Like you can go and meet with some people and set up a partnership. Typically, your tax professional should be able to help you with a partnership. We do that in our office all the time. Although if you are doing partnership with somebody other than your spouse, I still like to bring attorney into the picture. And when you come to me, I explain to you why. I go through step by step why it's important to have an attorney involved in the transaction. So when you invest in syndication, you know exactly what asset you're investing in, because that's the whole purpose of syndication is to do that one particular project. So that's a big difference between a fund and a syndicate. Syndications are often structured as limited partnerships where a lead investor or sponsor manages the investment, and the rest of the investors are basically limited partners. They could be passive, they could also be active sometime, depending upon how the partnership agreement is structured. Syndication focuses on a single project, single asset. For example, a syndication might be formed to purchase a specific apartment building or maybe a commercial building. Returns are generated from the performance of that one specific project, from that one specific investment. And distributions are made according to the terms of syndication agreement. And the control have, um, so I guess in this case, in syndications, investors have more control and they also have more insight into a specific investment, often with the ability to review due diligence materials. The sponsor manages the day to day operations and decision making. Now, if I was helping a client set up a syndication, this is what I will advise them. However, at the end of the day, all partnerships are governed by the partnership agreement. So if you are investing in a syndication, you need to request the partnership agreement and get it reviewed by an attorney. If you skip that step, that can be quite dangerous for you. Like I said earlier, just like fees for funds, syndicates can also have a fee. So they might have acquisition fees, management fees, profit sharing, all kind of fees. So figure out what kind of fees they have, and if there is anything you can do about it. Most likely not. There's probably nothing you can do about it, but probably worth asking, right? Now, if you're investing in syndication, then the due diligence process might have some additional things you should watch out for. So I'll go through some things that I have noticed, but in no way it's a comprehensive list. You should, like I said, at the end of the day, you should really go back and take a look at the operating agreement and then kind of go with that. So first thing I would probably ask is obviously the detailed information about the property. I will ask them for due diligence. Ensure you have diligence documents, property inspections, appraisals, environment reports, zoning information, and review them. Most likely in a syndication you will be allowed to do that. Funds will be a little bit difficult, but syndication makes it a little bit easier. Evaluate the sponsor experience and track record with similar projects. Ask about previous syndication they have managed, their outcome, any challenges, any lawsuits, any kind of those problems. But in syndication, I'm always looking for skin in the game. Check if the sponsor is investing their own money into the deal. This can indicate their own confidence, right? So if they don't spend any money and they want your money to invest in it, I'll be a little worried about that. If you go on YouTube, Instagram, TikTok these days, how many people are teaching how to build wealth with other people money? Most of it is scam. So I would be very careful if somebody's asking for your money and they're not putting their money into the particular project. Ask how much of their own capital have they committed compared to the amount raised from investors. How's the equity split look like? Understand how profits and cash flows are distributed between the sponsors and investor. Ask about equity split, typically ranging from 50-50. Is it 70-30, 80-20? What does it look like? Um, are there any preferred returns? Determine if there is a preferred return for investors, meaning they receive a certain return on their investment before sponsors get a share of the profits. You would think the investor should get paid first. Ask what the preferred return rate is, if applicable, and calculate it. Inquire about the waterfall structure, which outlines how and when profits are distributed. Understand the different tiers of distribution and what triggers each one. For example, is it return of capital first? Is it the preferred return and then the profit sharing? Like, how are you getting paid? Uh, Once again, figure out what the exit strategy look like. You know, um, Debt structure is probably the most important in syndications because they can always ask you to bring more money to the table. Clarify the amount of leverage being used and terms of financing. Ask about interest rate, loan terms, any potential refinancing plan. So those are the things I would probably pay attention on. But like at the end of the day, like I said, operating agreement is the king. Review it carefully and pay attention to clauses related to, for example, capital calls, decision making authority, and the process for resolving disputes and exit strategies. What if you need to get your money back? Is there any option or you kind of out of luck? If there is a possibility of capital calls, where investors might be asked to contribute additional funds. How would that work? What if you don't have those funds? What happens? Right? Ask how likely this is and under what circumstances they could ask you for additional capital. And most importantly, if you cannot provide that capital, what happens? Clarify what happens if you need to exit the investment early. If you can't wait for the entire term. Syndications are typically illiquid. You cannot easily take the money out. I understand that, but you should understand that. Figure out what are your options. Is there a procedure for transferring your interest to somebody else? What if you find somebody else who wants to take over your syndication? Is there any fees, any penalties? You know, and like I said earlier, similar to the funds, because the example I covered earlier was about real estate. So once again, if you're if the syndication is about real estate, then figure out the market fluctuations, impact of interest rates, downturns, how long you're going to hold the property, and make sure there are strict guidelines around that. So those are the things I will watch out for if I was investing in syndications. And lastly, there are partnerships. Like I said, partnerships are syndication is type of a partnership as well, but I'm talking about partnership when you and three of your other friends meet on a dining table and you kind of decide what you want to do as your next project. Maybe buy a single family home, maybe buy a restaurant, maybe buy a franchise business or whatnot. So you can do that. And the basically, as long as you as a partners agree to do that business together, then all you got to do is come to me. I can tell you all about how partnership work, get an attorney involved to draft up a partnership agreement, and we're good to go. This is the process of partnerships, fairly straightforward because everybody is a decision maker in a partnership. So that's the idea. I hope you found this information very helpful if you're planning on investing in syndications or funds or partnerships, and you kind of understand how all of these things work together. I have a couple of asks from you. Number one, please subscribe to the channel, share it with your friends, family members. That would be a big help. Uh, and number two, we will be doing a Wealth Summit on November 10th, 2024. So November 10th, 2024, it's going to be in Newark, California. We have a big facility this year, almost 600 people going to be there. It's going to be a fun event from 8 a.m. to 8 p.m. the entire day. So it'll be a lot of fun. We're going to go over various kind of tax strategies. We'll talk about fixed income. We'll talk about financial planning, estate planning, all kind of different opportunities will be at the event as well. So please do register. If you have a tax question or a financial question you want to get my opinion on, you have two different ways. One, you can set up an appointment with me, consultation appointment. Just go to taxcodeadvisors.com and you can set it up that way. If you have a general question that you would like me to address in a video format, then go to my WhatsApp group. And then from there, just reach out to me. Tell me, hey, Deepak, I'm not looking for an appointment. This is what my question is. Can you give me your opinion? You can ask me about tax question. You can ask me about economy. You can ask me about a particular project, anything you like. If you're just asking for opinion, not an advice, just an opinion, I'll be happy to give it to you. If I have some time, um, and if it makes sense, right? It needs to be something that appeals to a large number of people. And if it does, I don't mind sharing my opinion with everybody else. So once again, thank you so much for watching this video. I hope you find this information helpful. If there is anything I can do to help, then please go to taxcodeadvisors.com and reach out to me from there. I'll talk to you soon or see you on our next discussion call.